India is currently facing a silent economic shift that looks less like a standard market correction and more like a permanent structural reset.
Oh.
To understand why, we have to look at the unprecedented double squeeze hitting the nation in 2026. First, India is caught in a liquidity and debt trap that mirrors the fragility of the 1997 Asian financial crisis. The country has accumulated over $760 billion in external debt, with more than half of that denominated in US dollars. As the rupee depreciates, reaching record lows against the dollar, the cost of servicing that debt rises automatically. The government has already spent $40 billion in just 10 weeks to defend its currency and stabilize energy imports, while foreign equity ownership has plummeted to a 14-year low. But unlike 1997, this crisis has a second, more permanent dimension. India's economic engine, its $315 billion IT services industry, is being hollowed out by artificial intelligence. Routine software engineering, quality assurance, and customer support tasks are no longer being outsourced to offshore teams. They are being automated by generative AI platforms. This means Indian tech giants are now forced to spend their capital on expensive Western enterprise AI tools, essentially transferring their wealth right back to Silicon Valley. It is a double blow where the cost of debt is rising, while the primary source of foreign income is being structurally displaced. Even traditional safe havens like gold are seeing pressure. As investors move toward ultra-high liquidity and short-term assets like 3 to 6 month U.S. Treasury bills, it is a defensive play, much like the one Warren Buffett has used, to wait for quality assets to hit deep discounts once the full scale of this transition becomes clear. This is the hidden reality behind the headlines. That India is currently facing a silent economic shift that looks less like a standard market correction and more like a permanent structural reset. If you had to choose between keeping your wealth in local assets or moving toward global liquidity, which would you trust more in the coming year?